Bad news is bad news for the stock market. Bad news is good news for the stock market. What I mean by that is when you have bad economic reports, in other words, economic reports that come in worse than expected, sometimes that can drive the stock market higher because the general feeling is that the Federal Reserve will cut interest rates and stimulate the economy. Other times you have bad economic reports coming in worse than expected, and that's bad news, where investors go, wow, that means the economy is really slowing down, and the Federal Reserve probably can't do that much about it. So this is an important cycle because the narrative does drive the market. So I start off my Thackray's 2025 September newsletter with this as the first piece here. And so we'll jump into the newsletter, and we're going to do a video of the newsletter and go through the different parts. Maybe add a little bit as well as we go along. But I'm going to start with the bad news, good news scenario. This diagram depicts the relationship between bad news is bad news and bad news is good news, and how it can affect the stock market. So on the left-hand side, we have the bad news is good news, where it drives the stock market higher because everybody cheers on the fact that the Federal Reserve will cut its federal funds rate at a faster pace than previously expected. And on this side, we have it where we've got bad news is bad news. In other words, the economy says, hey, we don't care. The Federal Reserve is cutting rates, but we're in a recession or a very strong slowdown. So bad news is bad news for the stock market. So where are we today? Well, we've seen reports coming out on both sides. We had the non-farm payroll number that came out, and that reacted on the downside a little bit, where the stock market said, that's bad news. The non-farm payroll number, the employment number, is really worse than we expected. And that's going to affect the economy. But then we had the PPI numbers come out for inflation, and the PPI numbers were worse than expected. And so what we saw was the stock market went up. So we've seen a little bit of both. So where are we? We're right up here. We're at the top here, where both bad news is good news and bad news is bad news for the stock market. Both of these are occurring at the same time. Well, different days, obviously. But so this phenomenon, it can continue on. We've had one big report where we saw the stock market react negatively. That was the non-farm payroll report. If we find a couple more reports come out like that and have the same impact on the market, that's usually when the narrative flips and people really become concerned about economic growth. But right now, that hasn't happened, which is still good for the stock market. We're somewhere here on the top. We haven't gone over to the whole bad news is just bad news cycle yet. I have this next piece I talk about bond investors know. Now, what I mean by that, because most investors watching this video are stock investors and they don't really care about bonds, but there's something really interesting happening around the world in the bond market. Now, I've been highlighting this for a while. I am seeing more and more people pick up on this recently and seeing it on CNBC, etc. But this is important with what's taking place. Basically, bond investors are revolting against the government spending more and more money, recklessly driving up their deficits and their debts. And this is like across all countries. I'm not picking on one country. It's happening in the UK, France, the USA, Canada. Exactly the same phenomenon is taking place. But to fully understand the situation, you have to go back to 1981. This is 1981, so I did this diagram here, and I'll show you what this means. This is the interest rates on the axis, x-axis, and down here is time. And I start off here with approximately 1981. This is after Paul Volcker raised the federal funds rate to something close to almost 20%. We saw it rise up really quickly as well because Volcker really wanted to crush inflation. But what happened? I'm not going to talk about that. What I'm going to show you, though, is after that time, we've seen interest rates move down, 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 fairly consistently. Yes, of course, there's some wiggles along the way. And at the same time, look what's happened to government debt. They've gone up, 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 up. Well, why? Well, because the interest debt charge, how much they have to pay on the interest, because the rates were coming down, so all new borrowing was at cheaper rates, as their debt was going up, they ended up with a cycle where, yes, the government debts were increasing, but not at a rapid rate because interest rates were coming down. Well, that's changed a little bit. So if we go fast forward to around 2020 or so, what we've seen just after that is we've seen rates start to pick up here. And so that's right here. Rates are starting to pick up. And guess what's happening to government debt? And it's starting to pick up as well. And so the interest charges here are starting to increase. And this is what bond investors are worried about. They're saying, well, we've given you this carte blanche for so many years because, yes, interest rates were going to continue to go down. Well, that's not really happening at the long end here at all. There's a difference between the short end, the middle, and the long end. But the long end, that's not happening. Interest rates are moving up. And so this is becoming more and more expensive for governments to finance their debt. And they don't seem to be cutting back on their spending. It's just absolutely incredible. They're absolutely committed to spending reckless amounts of money on things that really don't help the economy. And if you take a look here, we can see here, this is a diagram put out, and this just shows you what's happened and the interest costs. You can see how they've all started to rise for all of the countries going all the way across just after 2020. As interest rates started to move up a little bit at that point. This diagram here shows the interest rates for the US, France, Germany, the UK, Japan. They're moving up, all of them. This is the long rate, so we're looking at the 30-year rate here. They're all moving up for the same reason. And the UK is at the highest here. The UK, they're in real financial trouble. Their society is imploding. The government has done some crazy economic stuff. It's being badly mismanaged, and it's possible that they may actually have to go to the IMF for financial help. And they're still spending as well. So we're seeing all these rates rise because investors are saying, no, if we're going to lend you money for the long term, we want to know that you're going to be starting to cut back money because inflation is a longer term concern compared to what it was before. This diagram on this side basically shows the same phenomenon with the different countries' long-term rates, but this is also showing the S&P 500 yield as well, and it's gone lower and lower here down to this level here. So it's showing you on a relative valuation for the long bond on interest rates versus the yield of the S&P 500, how highly, richly the S&P 500 is valued at this time. On this page, we've got some basic diagrams here that I've included. They're not all inclusive. There are other variables, but I wanted to illustrate some of the concepts around the different markets as well, as far as fair valuation goes. In this diagram here, I've got economic growth. This is when economic growth is increasing on the y-axis, and over here we got market metrics as far as valuation goes, something like PEs, and that's higher as we move up the y-axis. If we take a look here, this is the US. This would be characterized by high economic growth, and also too we've got, in this case, high market metrics, particularly in a few companies like the Mag 7, etc. And these companies down here, this would be countries like Canada as an example. Canada has a lower economic growth profile, and on top of that, it has lower valuations in the stock market overall. And the U.S. has done particularly well because it's actually had stronger economic growth, and at the same time, we've seen stronger earnings growth over time that's really come back into those companies. What I'm trying to illustrate with this graph is that despite the U.S. being a great success story over the last number of years, other markets, such as the Canadian market, even though it doesn't have that strong economic growth, because they have a lower value relative valuation, they can still do well and outperform the U.S. market. And that's exactly what we've seen recently. We've seen a move towards, in this case, other countries outside of the U.S. and even countries that have a very low economic growth profile, such as the U.K. earlier this year did well, despite the economy not doing well, and as well other countries such as France. This graph over here is a similar graph. This is a price to earnings ratio. So now we're putting the valuation on the x-axis, and this is interest rates. This is important because we may see a new paradigm here. If we have longer term interest rates going up, that actually might switch the whole lens that investors look through. So let me explain. So this is what I call the fair valuation line. So at higher interest rates, there's lower PEs, like a lower valuation. So why is that? Well, when you're buying something like a tech stock that's a high growth stock, when you buy stocks in general, you're buying a discounted cash flow further out into the future. Because they're growth stocks, you're paying a higher multiple and expecting more money way out in the future as the company grows. So as interest rates move up, so as they move up here, that means that it's a bigger opportunity cost to buy tech stocks, because with higher interest rates, you're going to get more money in other sectors of the economy on a relative basis. So other stocks become more attractive, high dividend stocks as an example. And so we've been operating in this case here when we've had lower interest rates for a while, and interest rates have been low, and at the same time price earnings has been high. But in the future, if interest rates are moving up, we're going to move this way on the curve. The value component of the market may become more attractive just because of the duration of income coming in on those stocks versus growth. Once again, this is just another lens to say that the market's shifting. We're seeing sectors rotate. We're seeing sectors such as the metals and mining sector, as an example, do well. And sectors that haven't done well in quite a while for a number of reasons, but this is part of it. This graph below shows the TSX, and this is TSX relative to the S&P 500. And we have seen the TSX recently outperform the S&P 500. And a lot of it has to do with this phenomenon taking place. There are some other factors, but this is definitely part of it. Okay, if we turn the page, we can see that I have a little bit of a seasonal trends here. September tends to be the weakest month of the year, and I got a couple of basic stats here. Negative 0.8 since 1990, positive only 49% of the time. What that means is there are some Septembers that are positive, but it just has a higher likelihood of the market not doing well, or the S&P 500 not doing well in the month of September. Now, filming this a few days into the month, and we're seeing a positive response so far for the market. I have to tell you that it's the second half of September that tends to be the weakest part. In fact, the last 2 weeks in September tend to be the weakest 2 weeks of the year on average over the long term. Okay, so let's take a look at some of the seasonal opportunities. Let's start by taking a look at gold. Gold's been on fire, and everybody wants to know a little bit about gold. We saw gold consolidate for quite a few months here. Now, gold goes through consolidation phases and moves up either strongly or down strongly at the end of that. And what we saw was that breakout at 34.80, and we've seen it move up higher, which is a positive note. And that can continue on for a while. But on a seasonal basis, gold ends its strong seasonal period October the 9th on average over the long term. Now, obviously, it can continue to move higher and last longer or shorter as well, but on average over long term. But you have to take a look at if seasonality has changed and for what reasons. So let's take a look at this heat map. I've included a heat map here. One of the techniques to actually look at this tool. So the more red, the stronger the positive result. The more blue, darker blue, the stronger the negative result. So let's take a look at October here. And you can see here that over time, we did see some blues here, but over time we've got a little bit more red on average. So what's happening? So October on a seasonal basis tends to be a weak month for gold over the long term, but it's becoming more positive even in that trend. Well, why? Well, you have to go back a ways to take a look. If we take a look, we did see back in the 1990s that central banks were huge net sellers of gold. And I know it's hard to believe, but they were. So they sold a lot of their gold. In fact, they actually had to have an agreement. They said, we're selling so much gold that we're driving the price down. We have to really try and curtail that and allocate properly. And so they all signed up to this big plan and said, here's how much each country can sell each year and no more. They were capping you. And it seems a little funny now, but so that's exactly what took place, and that actually was kept going for many years. And so that actually was also pushing downward pressure on gold as well, particularly in the month of October, because when they signed this plan, the start date for the new allocation was October 1st. So we have seen a lot of selling gold, but that's no longer true. Central banks have been net buyers since 2010, and they just keep buying and buying and buying. So we've seen a little bit of that causational factor being removed, and we are seeing October being a little bit more positive. So it is possible we could see it run further, but you should know that the average long seasonal period does finish up shortly. Okay, so let's take a look at gold miners. Gold miners, they have been on an absolute tear, exactly the same as gold. They had this consolidation period, then they've really ripped higher from that time period. One of the reasons why we're seeing gold miners actually perform well is, yes, gold has done well, but also the metals and mining sectors. Not just gold, but the metals and mining sectors also been moving higher. So when you have that combination, it tends to push up gold miners. And if we take a look here, look, here's gold miners. Look at this, same phenomenon where gold miners tend to also be negative in the month of October on average over long term. But I want to go to the heat map and say that it's not quite as bad as it seems. The same phenomenon taking place here for gold miners going back to 1984. Here you can see that we do see that blue. It's not very dark, just because it's an average and median compared to a bigger dispersion numbers in the actual sample size from 1984 to 2024. But if you look at this trend here, we can see a lot of blues back here really driving this trend. And that was, like I said before, central banks selling. But also if you take a look at the dates of when this was taking place, a lot of this was actually happening when we were in the tech bubble before. In that tech bubble, what we found was investors shunned gold coming into, well, into 2000 before the technology stocks start to roll over. Up until that time period in the late 1990s, gold did not perform well. And there's a lot of investors going, why isn't gold performing well? Well, we just don't get it. Why isn't oil doing well, et cetera, et cetera? And the commodities just did not perform well. And so we saw that whole spectrum, and that's why we see a lot of these blue rectangles here. But you will see that over time we are starting to see more red happening for the gold miner sector, which is positive for gold miners. So we actually see gold miners finish the strong seasonal period later if the market does run from here. Silver update, breakout, just like gold miners. Okay, let's talk government bonds. Now, earlier I was talking about long bonds. I was using the example of 30-year U.S. government bonds and Japanese bonds, etc. Here I'm looking at the midterm bonds, so 7 to 10 years, the notes, okay? If we take a look here at government bonds, I want to start with this chart here. Government bonds have actually done well in 2025. They've been off the radar because everybody's been looking elsewhere. Now, they haven't had a huge move, but they have been positive, and you can see that here for 2025. This underline here is 2025. And here we've got this top boundary here. So this is really an ascending triangle, which is a positive formation. We did see that breakout take place. That's positive. September tends to be one of the strongest months of the year for government bonds. And so so far it has been fulfilling that trend. But if we take a look here, let's go back, take a look at government bonds. We're looking at from 1998 to 2024. And if you take a look at October, look at October. Look how dark blue that is, even on this phenomenon here, this sample size, I should say. Now, it's a smaller sample size, so it's more likely to happen. But that is the worst month of the year on average and a median basis. And you can see here that I want to point out that even recently, in recent years, we've seen some dark blue squares here, which means that the trend of negativity is very strong in the month of October for government bonds. Government bonds, U.S. government bonds, midterm government bonds finish the strong seasonal period October 3rd. They have a strong tendency to correct after that into late October. Something to watch out for despite them actually performing well. And I know there's a lot of talk about, well, inflation and PPI and inflation, government bonds moving down. In fact, today, earlier, government bonds, U.S. 10-year government bonds went below 4%. And so we have seen that move down. So we may see government bonds continue to move a bit lower, but you should know that on a seasonal basis, October 3rd tends to be a pretty strong demarcation line for a seasonal trend to start going the other way and start to head down for government bonds. Okay, so let's take a look at CAD USD here. We have seen that pullback really taking place over the last few months for CAD USD, so the Canadian dollar is weakening. We did see that earlier in the year. We did see that move stronger for the Canadian dollar. That was the US dollar going down against all world currencies. Everybody's just selling the US dollar, and so the Canadian dollar benefited from that. We've seen the US dollar actually picking up strength from July. So July, August, and September relative to world currencies, and including the Canadian dollar as well here. So I think the exaggeration about the US dollar is dead is just that. It's an exaggeration. I think it's an overestimation. I wouldn't count on the US dollar being dead yet. I know Trump wants to have a lower dollar, and it's possible we may see things develop that would allow that to happen. But right now, we could be in the scenario. When I did an earlier video, I talked about how The worst first half of the year, going back to 1972, was 1973. The second worst half of the year was 2025. But if you go back to 1973, the second half of the year, starting in July, actually was positive. So maybe we're in that type of scenario where the US dollar does do well, particularly if we go into risk-off mode here. Now, risk-off, back when the tariff debacle was taking place, drove money out of the US. And everybody said, I want to re-domicile the money, the pension funds, et cetera. We want to re-domicile money back because we just don't know what's going on. I think things are a little bit more settled down here, so I'm not sure that that would happen again in a risk-off mode. I wouldn't count on that taking place. And in risk-off mode, typically there's a greater demand for dollars. So once you get back past that, hey, I'm re-domiciling, you can see an attraction of the US dollar. So the US dollar tends to do well against the Canadian dollar up until mid-December. So we could actually see this head lower. I put on the graph here, I put on the price of West Texas Intermediate crude. It has moved lower. It's one of the factors that drives the Canadian dollar relative to the US dollar. I also look at the differential between the two-year spreads between Canada and the US. It's not shown here, but one of the major driving factors has been the West Texas Intermediate crude not performing well over the last few months. And I've got a heat map here once again for the Canadian dollar. If you want to take a look at that, you can see some of the trends taking place. It tends to be a little bit negative here in this time period, but then we start to see a little bit of positive development taking place in January. Utilities, look at utilities. Utilities was actually negative in September, underperformed the S&P 500. It tends to be one of the strongest sectors. In fact, it has been since 1990 to 2024. It's been the strongest sector in the market, major sector in the market, if we're looking at major sectors. And that didn't happen. It was a risk-on mode, so investors were moving elsewhere. If we take a look at uranium, uranium tends to perform well from basically early October into late January. It tends to be a strong seasonal period. Now, we saw this strong run for uranium. We've seen a consolidation taking place here. And now we're back up to the top of this consolidation box. We could see a breakout for this take place, particularly if we see the metals and mining sector do well. So some correlation between the metals and mining, for obvious reasons, and the uranium sector itself, and energy. So there are some correlations taking place, but it is good to see this consolidation taking place and a possible breakout right before the strong seasonal period for uranium. And relative to the S&P 500, we're seeing that breakout possibility as well. Consumer staples. If you take a look at consumer staples, the sector's really just been performing at market over the last while. If you take a look at 2025 versus the S&P 500, up and then back down. So we're really basically performing at market in 2025, because it did start at a lower level here as well to go up here. And really, it comes down to investors keep focusing on some of the growth sectors of the economy. That could change because we are back down to this baseline here, particularly if we start to run into trouble. I do want to say that the consumer staples sector tends to be one of the strongest sectors of the month in October. Now, why is that? It's a transition month, October, when we move from the unfavorable seasonal period for the stock market. It hasn't been unfavorable this time around, into the favorable time period. And it tends to be a more volatile time. So we see investors attracted to sectors such as the consumer staples sector. Okay, it's rant time. And if we take a look here, my first rant is, I say Canada is in trouble. I have to watch it. I don't like talking about politics in Canada. I don't like talking about municipal politics, and I don't like mentioning politicians' names. So I'm going to stay away from most of that. I am going to talk about municipal politics a little bit. Because it exemplifies a little bit of what's wrong with Canada at this point. And I'm going to come up with a non-political solution in the end. And I saw this article here, and it's in the Vancouver Sun. And basically it says that the Vancouver pools, run by the municipality, do not allow parents to teach their kids how to swim. Okay, now that had to be the stupidest thing I've ever heard as far as the regulation goes. My parents taught me how to swim. I taught my kids how to swim in a public pool. My kids will probably teach their kids to swim at a public pool as well. This is just the way it goes. Yes, swimming lessons are great. We put our kids in swimming lessons as well. And it's a great compliment. And in fact, you want to be swimming with the kid, teaching them, because it shows them how important swimming is, because you're leading by example. So this has got to be one of the most ridiculous regulations that I've seen. I'm guessing it comes from some sort of liability issue, but this has just gone way too far wrong. I can't imagine otherwise. And if we go down here, I talk about overregulated societies, and if you've read my newsletter in the past, I talk about how California is the worst run state, and how Canada better not be slipping into that, because if you take a look here, they started a high-speed rail line from LA to San Francisco back in 2008. It's cost $16 billion so far. Oh, and I tell you that not one line of track has been laid at this point. Not one. I mean, this is because of all the regulations that are out there. And then I go and talk about how they say, well, we're going to build small homes for homeless people. Some of them end up costing $500,000. I mean, this is insane. California has just killed itself with overregulation. And I'm not against regulations. You need regulations. I mean, it's not anarchy out there. But it can just go too far. Why am I talking about swimming pools in Vancouver? Because if Canada wants to fix the current malaise that it's in, we've seen over the last 10 years or so, flat GDP per capita. We're one of the lowest growing countries in the world. We go down the metrics, and here we are. We're actually one of the wealthiest countries. We've got lots of resources, and but we just need to do things differently. Let's put it that way. One of the things we need to do is we need to actually start removing a lot of these unnecessary regulations. Let's take, for example, the Ring of Fire in Ontario is a whole mining belt that has a whole bunch of rare earth metals, etc. They've been talking about doing this for 10 years, and really nothing's happening here. We need to remove regulations, and we need to do it whole scale, not on pet projects. Not say, okay, we're going to leave the regulations in place, but we're going to supersede the regulations for this pet project that we have. If we do that as a nation, Canada will not grow that fast. Yeah, maybe a little bit with some of the stuff that we come up with. Canada needs to say to businesses, we are open for business. Please come here and help us develop resources, et cetera, et cetera. And I'm not just talking about resources. I'm talking about just businesses being attracted here. And so we're seeing an overregulated society, and that's actually hurting Canada here. I know, Canada, we can do it. We can remove some of the regulations and make Canada a good place for businesses once again. Okay, so here's my next rant. It's about the Europe, the EU. And if we take a look here, I've got an article from Reuters, and it talks about the EU needs to get more funds from all the countries just in case there's a liquidity crisis because the US won't provide swap lines if they're in trouble. Okay, so let's start with the EU first and what's happening. The EU is in serious financial trouble. It's not really evident from North America so much, but if you take a look at Europe, France may actually have to go to the IMF. They're running into all sorts of problems. And look, in North America, we go, oh, we love the EU. It's one currency. You can go across borders. We don't have to worry about all this stuff. And they don't have to. It's a huge benefit. I agree, one currency actually does help. There's no question. But it is a huge negative as well because go back to Greece in the great financial crisis. Greece collapsed. If they had their own currency, they wouldn't have collapsed. It's just because they had a really expensive currency. So there's a lot of negatives. And the EU just goes around and putting Band-Aids on all of the different countries' situations. Like Italy, your bond yields are moving up too high. We're going to come along and buy more bonds, Italian bonds, and drive the yield down, which only encourages Italy to borrow more money, which isn't fixing the problem. And so they refuse to fix the problem. So the EU is an unelected body by the people. It's not elected by the people. And it's this huge bureaucratic body that tells all these countries what to do. And they're really trying to protect their powers right now. They're not as well liked as what people in North America suspect. I used to live in the UK when I was much younger, so I was familiar with the Maastricht Treaty, predated the EU. And this was the EU in its initial formation telling them, you can only have so much butter. We got to throw this out. You can only fish so much. You can only do this. And there was a lot of really discontent with the EU. And so a lot of people are not happy with the EU that live in Europe. So we have this fantasy picture in North America, and it's causing huge problems. We're seeing huge uprisings taking place in France, and some of the other countries as well. And the EU is really straining. There's a possibility that the EU may fall apart. I don't think it will, but it has become a big, huge bureaucratic fiefdom trying to look after its own needs here. And if we take a look here, what they're doing here is they're saying, well, because the U.S. won't give us swap lines like they did in the great financial crisis, we run into problems. We'll have to create our own pool and finance our own countries. What I find interesting in this article is that in nowhere in the article does it say, hey, the countries actually need to actually operate on a fiscally sound basis. No, not at all. That's not part of it. It's just governments spend more money. They used to have ironically, I'm being a little long-winded here, but they used to have a requirement to be in the EU, that you could only run a deficit of 3% of your GDP. If you were above that, you were not supposed to be in the EU. I mean, that's humorous at this point, right? I mean, yeah, okay. I think they're pretty well, most of them are definitely above 3%. So if we take a look at another factor here, well, here's a country here I want to point out, Poland. Okay, look at the growth rate, the GDP growth rate for Poland. Great. Okay, this is much stronger than the other countries. Why? Well, first of all, they pushed back on a lot of EU regulations. Once again, those regulations have really hampered growth. They pushed back and said no. And the other thing is they've kept their own currency, the zloty. So when you have a currency adjustment, that really helps out. And so a lot of countries in Europe are really being hurt by this. Anyway, I just wanted to rant a little bit about this to show that once again we have another band-aid from the EU trying to solve the situation without really addressing the real problem underneath. Thank you for joining me today. Please like this video and subscribe to the channel. Thank you.